Assalamualaikum and good day. So, our group will be presenting on the article of The Rise and Fall of Management Accounting.
So let's start our journey into the rise and fall of management accounting. As the system is compiled with the procedures and the cycle of organization, management accounting information is produced too late to summarize and too distorted to be relevant for managers' planning and control decisions. The system focused too narrowly on producing monthly earning reports due to emphasis on meeting quarterly or annually earnings target. And despite the resources devoted to compute the figure, it fails to measure the increase or the decrease in economic value that has occurred. The occurrence led to several consequences. Number one, reports are little help to operating managers to reduce costs and improve productivity. They decrease productivity as managers need to spend time to understand and explain reported variances that have little relation with economic and technological reality of the operation. The systems do not provide timely and detailed information on process inefficiencies. They focus too narrow on input that are relatively insignificant in production environment and distracts the managers from noticing the important key factors for production efficiencies. Number two, system fails to provide accurate product costs as they get distributed by simplistic measures and do not represent the demands made by each product on the company's resources. The methods used to satisfy external reporting and auditing requirements are systemically biased and manipulate the product costs at individual product level. Standard product cost systems lead to enormous cross-subsidies across products, where such distorted information represents the only available data on product costs. Thus, this will create dangerous opportunity for the misguided decision on product pricing, product sourcing, product mix, and the responses to rival products. Number 3. Managers' horizon contract to only short-term cycle of monthly profit and loss statement. Financial accounting system treats many cash outlays as expenses, even though they will benefit the future period. Managers are under pressure to meet the short-term profit goal, and they believe they can achieve the goals by reducing expenditure on optional investments. Short-term profit pressures can lead to decrease in investment for the long run. Monthly statement can signal increased profits even when the long-term economic health has been compromised. Number 4. Today's systems provide misleading targets for managerial attention and fail to provide relevant sets of measures that appropriately reflect the technology, products, processes, and the competitive environment. Financial managers are relying exclusively on predict statements, and they get isolated from the real value-creating operations and fail to recognize when the accounting numbers are no longer providing relevant or appropriate measures of the operation. So now we will proceed to opportunities. Firstly, increased demands for excellent systems occur when costs for collecting, processing, analyzing, and reporting information have been decreasing. Production processes are now under direct control of digital, where information can be recorded in real time for analysis of performance. Every transaction can be captured virtually for subsequent analysis. Automated parts recognition and tracking systems combined with LAN technology can provide continual status reports on work in progress. Systems can also accurately measure and attribute resource demands made by each product. Timely and relevant performance measures can be computed and circulated throughout the company. Secondly, designers of the system can use this complicated electronic technology to devise reporting and control systems that are more accurate, timely, and more effective. In before times, more relevant and timely procedures would have been too costly and even invisible, so most companies rely only on historical information. With the existence of the system, problems mentioned before no longer need to be tolerated in the present and future times. Computing revolution has so reduced information collection and processing costs that it has removed virtually all barriers to design and implementation of effective systems. So we know when one thing has their opportunity, they must have their own challenges. First, one thing has the opportunity, they must have their own challenges. Vigorous global competition, rapid progress in product and process technology, wide fluctuation in currency exchange rates, and raw material prices require expertise from corporate management accounting systems. The system must provide timely and accurate information to enable efforts to control costs, to measure and improve productivity, to construct improved production processes. Systems also need to report accurate product costs, so pricing decisions, introduction of new products, abandonment of obsolete products, and the responses to rival products can be made with best possible information. Secondly, system serves as a vital two-way communication link between senior and subordinate managers and become the means of communication for the goals and the objective of the organization. The accounting systems become a channel which information about the product performance and production efficiencies get reported to the top management. Compensation and promotion decisions are based on the number reported by management accounting systems. The third one, success depends not only on excellent system but on products that meet customers' needs, on efficient production and distribution systems, and on effective marketing efforts. Ineffective system can undermine even the best efforts in product development, process improvement, and marketing policy. Best outcome occurs when managers understand the insignificance of the system and avoid it by developing personalized information system. There will be possible risks if managers do not recognize the inadequacies in the system and incorrectly rely on it for contract information and product decisions.
Next, I will proceed with the management accounting rules and relevant costs. So we will start with the management accounting rules. The management accounting information which is information about the transaction occurring within organization is a recent phenomenon which is in the 19th century that create a new demand for accounting information. The emergence of managed hierarchical organization in the 19th century create a new demand for accounting information. To determine the price of output from internal operation, owner devised measure to summarize the efficiency of labor and material conversion. Early management occurring were simple, focusing on the conversion cost and providing summary measure of efficiency. However, advancement in the transportation and communication in the middle of 19th century allowed the growth of the large organization, but effective management accounting system were necessary to coordinate their operation and provide performance summary measure. Example of this system can be found in the Railroad Corporation in the middle of 19th century. For example, retail store chains also developed their own measure of internal performance, such as focusing on purchasing, pricing, and retailing activities. The management accounting measures were designed to motivate and evaluate the efficiency of the internal process. There was a little concern about measuring the overall profit of the enterprise, which is this organization really had to do only one activity, such as convert raw material into single final product. They had to do this activity really well. If this basic activity were performed efficiently, then the organization could be confident that it would be profitable in the long run. Thus, the management accounting system was created to promote efficiency in the key operating activities of the organization. Next, the final development in management accounting system occurred in early decades of 20th century to support the growth of multi-activity, which is diversified organization. A number of important operating and budgeting activity were devised by senior manager of DuPont, which is a powder company that formed in 1903, to coordinate the activities of their diversified operating group. But the most important of the management accounting innovation was return on investment, which is ROI. what is ROI? ROI is to provide an overall measure of the commercial success of each operating unit and of the entire organization. Only top managers use ROI, which is return on investment, to help direct their allocation of capital and to evaluate the performance of the operating department. But the enormous diversity in the product markets served by giant corporation required new system and measure to coordinate dispersed and decentralized activities. Lastly, ROI measure play a key role in permitting this internal market for manager and for capital to function. So, next we will talk about loss relevance. Management accounting had lost relevance in the middle of 1920 because of some reason. First, there was little incentive to continue develop innovative management accounting procedure because there was a model of the corporate organization form that was developed by some companies such as DuPont Company. Next, the increase in the diversity of product and complexity of the manufacturing process also caused the management accounting to be lost relevance. This situation caused some improvement in corporation product and process technologies, which is caused the companies to force the new demand to the management accounting. The third cause was the dominance of the external or financial accounting statement. This situation caused the demand for the income statement and the balance sheet to be articulate. Therefore, the method used to assign direct and period cost to the product was a direct method. The parallel system that happened to be not cost effective was the system of separating managerial purpose system with the external reporting system. The cost became not effective because of the information technology during 20th century. Last but not least, the cause of the loss in relevance of management accounting was because of the high cost of collecting data and providing prompt report to production manager. The cost become higher because the purpose of the process that was to permit the real-time process control. Thus, in conclusion, the manager decided to not invest in management accounting system. However, this decision must be reconsidered because a lot of improvement happened over the year, such as production in technology.
The subtopic is about the academics led astray. Academics led astray happened because of the university-based researchers who will fail to note about the growing obsolescence of the organization's management accounting system. There are some causes that lead to this academics led astray. First, the cause is because of the academics who were focusing too narrowly on a simplified model of firm behavior. The model is called as one production process model that was found out by the economists. By using this model, academics see only a little value towards the cost allocation imposed in organizations. The second cause of academics-led astray is because of the academic literature that were concentrated on an elegant and sophisticated analyzing cost approach for a single product. The literature emerged is about separation of cost into fixed and variable costs. This literature is very persuasive. However, this literature not fully address about some questions such as where does the fixed cost come from. Next, the third cause of academics-led astray is because of the management accounting become less relevant to the organization's operation and strategy. This is because many senior executives dominate their company with the belief that they can run the company by the numbers. Lastly, the cause of academics-led astray is because of the lacking knowledge and uncomfortable with the firm's underlying technology. CEOs usually look at the impact towards the financial measures when making decisions. But as the product life cycle shorten and the cost increase, the directly traceable cost fraction of the total asset become more lower. Next, I will talk about the sixth subtopic of this article, which is about the accounting for caravans. I will talk first about the accounting role for caravans. First, the accountant will compute the overall profitability of the venture. Then they will distribute the net proceeds, which is the retained earnings, among all of the initial investors. There is an example from the 15th century. There were some merchants from Venice that were trading goods with other country. The Venetian investor acquired goods in Italy. Then they chartered an expedition to India in order to sell the goods. At India, they purchased some tea to sell them back in Venice. After that, the accountant compute the profitability of the entire trip by deducting the revenue from the selling of the tea in Italy with the cost of acquiring the caravans and cost acquiring the initial load of the merchandise. Next, during the third quarter of the year 1487, a caravan was traversing the Persian desert en route to India. They probably not compute the profit for that third quarter. Why? Because the investors understood that it was not a meaningful exercise to compute the profit for only 3 months. Plus, they think that there are some potentially useful indicators that can be used to indicate the performance of the managers of caravan instead of using the quarterly profit. The cash flow also important to see the pattern and the structure of the company's cash receipt and expenditures. Last but not least, I will talk about the last subtopic of this article, which is about the innovation. There are 3 suggestions. Firstly, we need to design management accounting systems that can support the operation and strategy of an organization. Plus, the opportunity and challenges also already clear, so the designing process will be more easier. The second innovation is to immerse knowledge from experimentation and communication in order to use technology, because technology exists to implement the systems radically different from what being used today. The last innovation suggested is to develop new concepts for designing management accounting systems that are relevant. The academic researchers and managers that committed in developing this concept can recapture the spirit of innovation from 100 years ago. That's all from our group about the article of the rise and fall of management accounting. Thank you.